Welcome back to Opinion Journal Live in New York. Next up, we've got Wall Street Journal America's columnist Mary O'Grady, who's joining us to talk about one of our favorite topics, Ben Bernanke and the Federal Reserve. Welcome, Mary. So late Tuesday, the Fed released minutes of a March meeting that suggested that it's not likely to engage in something called quantitative easing for a third time, and stock markets promptly fell off a cliff. Let's do the basics first. What is quantitative easing, and why does the market seem to need it so much?
Well, as you mentioned, this would have been the third time that the Fed engaged in quantitative easing, which is basically putting more money making more money available to banks to lend out. The money doesn't necessarily go into the system. A lot of it is sitting in reserves in banks right now. But making that money available is what we mean when we say easy money. In other words, the money's there and it makes interest rates stay down. And the Fed believes that with low interest rates, there'll be more economic activity that will help boost economic growth and also lower unemployment, which is one of their key objectives.
So they put this money out there for the banks, and they hope that the banks are going to lend it out. But has quantitative easing worked the first two times?
Well, you know, that's a counterfactual. I mean, you don't know what would have happened if they didn't do QE1 and QE2. But I think you can say that putting more money out there right now, there's an old expression in monetary policy that when you put a lot of money out there, if there's not demand for that money, you're pushing on a string. You can't make it go any more. You're just putting the money there. And the problem is that when that money piles up in banks, it has the potential, when the banks start seeing opportunities, of creating inflation, because then that money starts to go out of the banks. The Fed pays 25 basis points for the banks to leave it where it is. If they see better opportunities outside in the economy, they start lending it out, and that would be inflationary. So I think what we saw in the minutes from March, which were different from January, is that some of the Fed staff is starting to feel a little bit uncomfortable about the potential for inflation. So they said, well, look, for now, we're not doing any more QE3. And as you mentioned, that was a disappointment because a lot of the game is expectations, and there were expectations that there would be more and more and more easy money, because that's sort of what Ben Bernanke had been signaling up until we saw these minutes.
So if indeed this doesn't happen, if we don't get QE3, then what does the market start to look for? And you know, has Chairman Bernanke made any indication of his own, of what he prefers to do?
Well, I don't think it's necessarily true that if we don't get QE3, the market will be disappointed. In fact, I think that you could make an argument that if short-term rates were more like 1% instead of 0, we'd be back to a more normal credit cycle, and that might actually be healthy for the economy. The problem is that if you had an environment where inflation started picking up, the Fed would have to step on that. It would somehow have to try to cut that off. And this is where the problem becomes more of a political problem than a technical monetary problem, because nobody in Congress or in Washington is going to allow the Fed to crack down, to tighten money when you still have 8.3% unemployment. And remember that the Fed has two mandates, what they call a dual mandate. It has a mandate to try to keep unemployment low, and it also has a mandate for price stability. So they can argue, hey, listen, you're not paying enough attention to that unemployment number. It's too high still, you know. And then the Fed's going to be stuck more, as I say, in a political problem than in a technical problem.